Good morning, traders. My name is Brad Matheny. Today is December 31st. Happy New Year. We are going to go over the custom indexes for all of you going into the end of the year. And again, the beginning of 2023, I'm going to be making some changes to my website. I'm going to be setting things up a bit more efficiently for all of you. I'm going to be restructuring the subscriber area. It may take me until January 10th or 15th to get everything done. Remember, all of this work, literally dozens of charts, updated algos and TT scanners, as well as other features, really takes quite a bit of effort. I have expanded out from 5 or 6 custom indexes to more than 18, I believe, right now. And I'm breaking them out into different segments. I'm going to be breaking out the real estate section into a different segment. I'm going to be breaking into a new gold and silver and metals segment for you. I'm going to continue to focus on the U.S. stock market and global equity markets for you. And then we still have the MENT rotational modeling system, which is our core element. That's why I'm starting this video, as well as many of the others with the same MENT rotational modeling system. The reason being is it's a top-down structure. We have the MENT rotational modeling system delivers the core constructs of our trading methodology. We use the MENT rotational modeling system's capabilities to tell us how we want to deploy our capital. And then from there, we make adjustments to our capital based on what we see on the TT scanner list, the live trade setups, and potentially the custom indexes, which we're going into next. Right now, we are seeing mixed bullish-bearish signals. We do not have any real confirmation of an uptrend or a major downtrend. We are mixed. So we have our allocation level set to 20% stocks, 55% cash, 25% metals, 0 bonds. And with the alternate allocation level, we got 20% stocks, 80% cash, 0% bonds. This is in case you cannot hold metals in your retirement account. What you could do, ladies and gentlemen, is try to buy some physical if you have the capacity to do so. Physical metals, which I have, are just, in my opinion, actually better than paper metals. So you can put your hands on it, you can touch it, hold on to a bar. It makes a big difference versus just buying GLD or GDXJ or what have you. So now, what we're looking at, ladies and gentlemen, is let's go to the beginning of this cycles. Here we go. Okay, we're going to start with the accumulation cycle phase. This is a new chart, new custom index. I've highlighted it a couple of times over the last couple of weeks, but you can see we've got this base. This is the SPY up here. We've got this base set up over here. We've got this inverted head and shoulders setting up. I was warning that we would likely get into a basing mode right over here off of this first low, off of an ABC correction. But I did warn that we could see a DE move, which we did see. And so I've been really warning of the end of a wave 4 correction. This is really a wave 4 correction going all the way back to 2009-10. And where we're looking at here is, if I'm correct, and this is the end of wave 4, we're going to start a wave 5 reflation rally back up here to the upside, which will eventually take out this high probably in early 2024 and eventually move the S&P 500 up to 5,500, 5,700, maybe even 6,100, which would be a huge move. That would be, again, about a 90% rally if my long-term predictions are correct, and that the globe moves away from risk and focuses on the strength of the U.S. market, which could drive a real 70, 75, 80% rally in the S&P 500 from where we're at currently. Now, the accumulation cycle phase is very important. You see distribution when this moves higher. This is distribution. Fear of a contagion event. You don't want to be holding on to stocks. This is where we get into choppy sideways types of trends. You start to see accumulation and upward trending when this is moving downward. You start to see distribution when we move into this sideways phase. You can see here during COVID, we had this extreme, let's call it accumulation. And then we had this massive distribution event during the deeper downside cycle. So everybody was like, I can't hold it. People were buying into this. Basically, it's not so bad. It'll come out of it. Then they moved into distribution saying, get me the heck out. I don't want to be a part of this. This could be ugly. And then the Fed shifted directions, and then we started moving into accumulation all the way through this phase here, right before the elections. And that's where we went into distribution for a period of time, and we distributed all the way out into this area where traders then started to really accumulate again. That's this selling pressure right here, selling all the way up into this area. We started to flatten out. You can see here, this is when I was calling for you to protect your capital, get out. If I remember right, I was telling everybody get 60, 80% into cash at this area. And then we moved into this broad distribution phase. Distribution is typically is associated with downward pricing cycles, and accumulation, when we start to move into a down cycle, is when we start to see real appreciation. So here you can see we had this peaking formation and we had accumulation. The accumulation took place through this area. Then we had distribution in 2018. We did see some moderate upward price advances here, but eventually we peaked at this bottom right here, and then we started to see some real accumulation through here. Okay, so where are we right now? We're in moderate accumulation. We've seen the strongest accumulation off of this deep, deep low right here. We need to see this continue to move downward, ladies and gentlemen. So we need to see this really kind of stall out and move back down towards this green level or a bit lower. That would show that we have some real accumulation. If we get into distribution where it continues to move higher here, then we're going to be looking to really prepare for a downward price cycle to take place in early 2023. Right now, we are seeing accumulation take place in this area of the market. That means that traders are kind of buying into this dip, expecting that the U.S. markets are going to weather 2023 and 2024 fairly strongly. We would need to see, like I said, a broad shift. We would need to start to see some sort of a real accumulation back to the upside here. We got a little bit taking place over the past couple of weeks, but we've seen this big bout of accumulation in red here take place. So we're looking for a real reflation trade, possibly back up into new all-time highs if my analysis is correct. Next, we have the cash flow index. Cash flow index is also reflating back up into these pre-COVID levels. You can see that we got below these pre-COVID levels back here. We've seen this extreme deep selling. We're back down here. This is a weekly chart. Weekly. And you can see we've gotten down into these extreme lows. We've reflated back up into these areas. A catalyst event could take us back down into these lows. So again, if COVID becomes an issue, the government tries another lockdown event, if we have some sort of a crisis event take place, financial, global war, or extended pandemic issue, we could see this move back down and attempt to form some sort of a right shoulder back over here. You can see we have this type of an inverted shoulder type formation. We could see some deeper move with a right shoulder over here. But right now, we've seen a fairly strong accumulation and reflation trade. We need to see how this plays out. We need to see how the early spring, January, February, March of 2023 play out. My gut tells me, and my custom indexes say that we've seen a deep deflationary trend. We could be looking at a reflation trade back up into this area, but we are really kind of, we've stalled. Let's put it this way. We've stalled into the end of the year. We don't know what we're going to do because the Fed has raised rates. Consumers are pulling away. Real estate could tank further. Global markets are struggling. U.S. dollar is still holding up fairly strong. 103, 104. That's actually very strong, ladies and gentlemen, for what's going on right now. And it could actually get a little higher. But long and short of it, we're not seeing any follow through of a reflation trade yet. Consumer engagement. This is really the fear factor right now. Consumers have pulled completely away from the market. We're back down to 2012, 13 levels back in this area right here. I mean, we're seeing consumers so freaked out by the Fed that we have not seen these levels. Look at this, all the way back 2013, 14, 15, 16. We have not seen these levels of consumer disengagement in forever. We had this one little blip here, 2015, which I believe was the elections. No, actually, that was not the elections. That was early 2015 collapse. These were the elections back over here, the 2016 elections. And these were the elections back March 2020. I'm going to do the math here. 2020, so that was November. Should have been the run up here into 2020. June, July, August, September. So the elections were back over here. And then right after the election, you can see consumer engagement just tanked. 2021, consumers really started to pull away. So what this is telling us, ladies and gentlemen, is right now we could be very close to a capitulation low. If consumers have pulled away from the market, and if consumers are expecting the market to contract further, we could see a bit of a January blip here, a bit of an additional pullback, seeing this move back down into these levels here, down into 14, maybe down here. But this would be a very strong indication that the Fed has broken the back of consumers. They are going to aggressively pull away from retail and spending. And that would mean that retail, car dealerships, you name it, other than essentials, would become at risk. And that would mean the Fed would have to really start to rethink rate increases going forward, because the consumer was re-engaging back over here, but now that's completely wiped away. We're at the lowest closing month ever for the past, so 13 to 23 over the past 10 years. And the real risk here is that consumers may continue to pretty much say, no way, we're not dealing with this. And that could mean that, you know, cars, houses, any real product could become an at-risk type scenario, and that's going to affect the GDP of the U.S. going forward. The custom devaluation cycle trend index, this is a very interesting cycle trend, brand new. And what I want to highlight here is this longer term cycle trend that goes all the way back to 1995-96, prior to the dot-com bubble, suggests that we can see down into these deeper areas, 2005, 6, 7, 8, 9, we start to get into a basing bottoming formation down in these deeper levels. Then we've seen an appreciation cycle phase with the post-COVID speculative bubble over here. Now we're back down into deeper cycle trends. This does not indicate that we are at a bottom yet, although we could be close to a bottom. How much deeper does it have to go before it finds a bottom? The answer I would tell you is, what is the difference between this and this? The difference here is that this is a U.S.-based global and financial crisis event. This is a U.S.-based financial crisis event, deeply deflating after this 2000 peak, where we never saw real, true price appreciation until 2012, 13, 14, and 15. That's where we started to see real appreciation. Now we're into a non-theoretical U.S. Crisis event. We do not have a crisis event yet in the U.S. We're not seeing massive financial crisis. We're seeing higher interest rates. We're seeing higher inflation, higher CPI, which is a global event. but not a U.S. event. If we move into a new type of a U.S. type of a catalyst event, then we could see this move considerably downward over the next 2 or 3 years. But I want you to remember, the SPY reflated almost 100% during this time frame. 2003 to 2006-7, the S&P and the NASDAQ reflated almost 100% during this time frame, during this weaker deflationary devaluation cycle trend. Could we see the same type of reflation trade while this is deflating? Yeah, I believe we could. I believe we could be in for a very strong upward reflation trade before we reach the 2027, 8, 9, and 2030 potential crisis event. Okay, would I have 2 of these? How did I got 2 of them? Okay, I got 2 of them. One must be a copy. Yeah, one is a copy. All right, get rid of the copy. Next, we have the large cap index. Large cap index is showing downward pricing pressure. This is showing end of year lack of trader confidence in the U.S. economy, in the ability to see a reflation trade. So I'm looking at this being capitulation. This could also be tax loss selling at the end of the year. You can see we had a broad decline overall, so that could have pushed some real tax loss selling into place at the end of December. We are nearing a deflationary cycle trend. We have about 4 or 5 months to go before this deflationary cycle trend ends. Sometimes these deflationary cycle trends can be completely opposite. In this case, this deflationary cycle trend has been fairly solid. We may see some sort of a base like this at the end of the year, or here, like the end of the year, or here, where it kind of rallied the last 4 or 5 months, preparing for some sort of an upward move. But remember, these cycle events are going essentially every 12 months. We have these cycle events. They're actually more like a 14, 15-month cycle. But we have essentially January, February, March, and then April, we get into the end of this cycle event. So Q1, we might see a bit of a reflation trade back up into this upward area. Otherwise, we've got to be very cautious of a capitulation move here. We could see January, depending on what happens with earnings and expectations, we could see January really form some sort of a, deeper low, maybe down in this area, and then start to really reflate back up the upside. I think January is going to be fairly strong. January, February. I think a ton of money is going to move back into the markets, expecting the Fed to possibly move away from these rates, trying to, stabilize GDP, and particularly with the spending that's coming out through the new bill that passed, the Inflation Reduction Act. We need to kind of see where we're at. But in the meantime, remember, we are staying safe. We are not trying to aggressively trade this. We're hypothesizing, so to say, on what may come. Next, we have the global asset index. Again, new lows, deeper lows. This really is not what we want to try to see as far as a global asset increase. We're not seeing appreciation. This may be a capitulation low, but we do not have any indication yet. We could come back down to these areas, so understand global assets could find additional weakness, and that could be very dastardly for the markets, particularly the global markets. But we do need to see if this is going to find any real support. You can see we're really, really deeply downward, deeply depressed. Okay, the Custom Innovation Index. This is a brand new one. This got me thinking about Tesla and the ARK funds and how innovation had this massive speculative rally and then kind of failed on out. There's a number of things going on here. There's a Fibonacci level and a range that I drew, as well as a standard deviation channel. We are very much right in this middle green channel right now, right off of these lows. This could become a very strong support level. This is a weekly chart. We could see very, very strong support over the next 2 or 3 weeks. Well, let me rephrase that. Over the next 5 to 10 weeks, the first quarter roughly of 2023, this could be really hammering out a bottom here. The whole speculative phase has wound up and then unwound all the way back down. Now, we could try to get a little bit lower, but I'm telling you, this looks very deep, undervalued for the innovation sector. It could still move down into this lower level, so we could see it move. If I were to tell you, hypothetically, another 10 or 15% downward into this 42, 44 area, but that would be fairly deep, ladies and gentlemen. That would be down into this lower green level, like these COVID lows. So be aware, we could be setting up a big reflation setup here, from these 40 areas, maybe up into these 70, 80 areas. We just need to see how it plays out. The markets are unwinding very efficiently. Oh boy, do I have two of these? Yep, I do. Tried to set these up this morning. I probably am going to have a couple of copies. Okay, custom fear index. I think we've already gone through this. Maybe it was in the other video. Fear is slightly elevated, 7.65. That's not too much to worry about. It's enough to be concerned. But remember, the MENT rotational modeling system is keeping us safely away from the markets. S&P is trying to find a base bottom here off of this inverted head and shoulders formation. The last couple of weeks in December were not very attractive. We've formed in a slight little doji right in the midpoint area, roughly 50% area here. We really need to see what happens and stay protected going into the beginning of 2023. The custom market sentiment index weekly has shown some price appreciation, shown some upward movement, while as the SPY was weaker. This is telling us that traders and consumers are anticipating a reflation upward cycle in early 2023, but we're not seeing it materialize in price. And the fear index is slightly elevated. We need to see this actually move downward. Fear index has got to go below, say, 6.50 and start to trend downward. The S&P has got to start to trend upward, and this custom sentiment index has got to start to trend upward. That would be a good indication that we're seeing a reflation trade. If we see this stay above 7.15, 7.20, and this weekend, then we are looking at a deeper low in the markets, ladies and gentlemen. We are not immune from risk right now. We just kind of slid into this sideways nothing trend, looking for something new in 2023. Custom tech ratio index, extremely low, kind of like that innovation index. Very deep, extremely deep. Way back here to 2000. I mean, you got to go all the way back here, 2011 levels. And this is where we found real solid basing and support over here. So I believe this is a good indication that we're going to be seeing some basing support in early 2023 and maybe a reflation trade in technology. It's going to really all depend on, the Amazons and Microsofts and Googles in earnings and expectations going forward. The reality is, I think we're going to see a reflation trade once this all gets settled. I think we've unwound sufficiently, and I think we're going to try to reflate back to the upside leading into that 2027, 28, 29, 30 area range. The real crisis event more towards 2028, 29, 30. U.S. custom to global market index. Global markets have really rallied off of this base bottom. They're holding up much better than the U.S. market here. We still have this downward trend cycle. It's kind of hard to see. I might try to draw something, but if you come across this high here, come straight across here, you'll see that we have this downward cycle. Same thing over here, downward cycle coming down across here. I will tell you this, if we get a strong upward bounce in early 2023 and break that trend cycle, there's going to be a large amount of impulse buying off of the breaking of that downward cycle. So understand that breaking the downward cycle across these highs, if the U.S. market gets up into this area and breaks it, finds support, and the global markets do the same thing, we could see a really strong upward reflationary trend. If they fail to break that upward trend, Ultimately, ladies and gentlemen, the answer is that they're going to try to consolidate back down here near these support levels, and the global markets here will try to consolidate down here near these COVID low support levels. I don't think the U.S. market's capable of getting too much into this area. I think this would be a very strong collapse of the U.S. market. I don't think that's likely to happen. The global markets could come back down here and retest these COVID lows. I could see that happen, especially with a bit more global unwinding. But really, ladies and gentlemen, we're flagging out. We're trying to move higher. We're trying to base. We need to see that actually follow through in 2023. Custom valuations trend index, weaker at the end of the year. Again, tax loss selling. Really, I don't know how to say it, but this looks a lot to me like this type of selling. You get this move here, you get this impulse selling, you get it stalling, you get more impulse selling, you get the dojis, and then you get the let's call it the contagion selling event. And then you see the same thing here. You got the impulse selling, the flagging, the impulse selling, the dojis, and then the flagging contagion capitulation type selling event. Same thing over here. Impulse selling, flagging, impulse selling, dojis, capitulation selling event, strong reversal. So get ready. I really think, in my opinion, that the markets are going to listen to what's happening in Q1. We've got the Inflation Reduction Act hitting in January 1. We've got the Fed likely to be paying attention. We've got consumers pulling away, which is very, very indicative of capitulation selling. Everything is down at 2011, 12, 13 lows on my custom indexes. I think we're going to see a pretty strong bounce in 2023. All right, I got to speed this up. Custom leading index, again, inverted head and shoulders formation, deep low formation, very deep lows off COVID lows here. So we've already seen the bottom. We could attempt to retest it. That's not unlikely, but we've already seen things start to move higher. I think we're going to see a good solid reflation trade. Custom volume index was still positive. We didn't see the deep selling like we saw here. This was a big trend change. And then we saw a lot of accumulation or attempted accumulation take place going into the end of the year as a whole bunch of nothing. In first quarter of 2023, I think we could see some very big upward spikes and some real upward movement. The commodity to gold index, okay, this you need to understand. Housing is going to be weak. There's nothing you can say about that. I don't see housing coming back in unless the Fed drops rates considerably. This is a basis that is based on lumber. This commodity gold index is lumber and another of other factors compared to gold. What we're seeing here is very similar to the 80s and the 2003 cycle event. Okay, housing did not really start to move in 2002 and 3 and 4 until 2005, 6, 7. So you need to understand that we could see this flag out, stay lower, not really see any real price appreciation while houses continue to stall, while the Fed continues to readjust rates for inflation, and while we see some sort of a moderate inflation event. Remember, 2003 through 2007, the NASDAQ and the S&P rallied almost 100% off of their lows to go back up to the highs, the 2000 highs. So we could see the same type of reflation trade take place in 2003, 23, and 24. We could see the U.S. markets, the NASDAQ and the S&P, rally to new all-time highs within a 12 to 15 plus month time frame, while this index stays extremely low because excessive commodity and inflationary concerns. So be aware, this is telling us that housing may not come back out of the woodworks for another 2 or 3 or 4 years. But that does not mean that we could not see a reflation trade over the next 24 months in the U.S. stock market. Custom metals trend index. I wanted to highlight these a little bit separately, but I'll go over this. Metals are really accumulating, guys. If you're not following my research, I was calling for it way back over here. And all through this downtrend, I kept telling everyone how this is a wonderful opportunity to try to get involved. Metals are going higher. This is, to me, the same as 2003 to 2005, where metals were capitulating Metals moved up almost 60-70% over that time frame in 2003 to 2005 before moving another 190% higher to go ahead and peak out in 2011. I believe that we're going to see metals more than 400% higher by 2029 from where we're at right now. And we are seeing this really accumulate. Even though the price of gold and silver hasn't really started to accumulate so much, I'm telling you, behind the scenes, global central banks and traders are accumulating metals hand over fist. This is a very good sign that we're moving back into a reflation trade, and traders are now looking at metals as the safe haven that they really are. Next, the FANGs index, basing and bottoming. This really goes along with the innovations index and the other index I showed you with regard to the technology sector, getting a good solid basing down here near these extreme lows. Remember, this is the COVID low back here. So this is extreme technology pressure, global economic pressure, and we've come down near these lows. We're weakening a bit. We could see a bit of capitulation move in early 2023, but we're very, very undersold in technology right now. I think technology could move at least 30-40% higher through the end of 2023. Custom metals index, again, this is more of a correlation to price for gold and silver. Gold, as I believe, is 1840, 1860, and silver is about 24, a little over 24. You're going to see this really start to accumulate over the next probably 4, 5, 6 months, barring any contagion event. If we get into some contagion event, we could see gold and silver do like they did over here with COVID, a brief 15-20% collapse and then a real strong rally phase out of it. But again, we've seen it really start to accumulate to the upside. We've bottomed, and we've moved 4 or 5 months into the upside, and we're seeing very strong accumulation. So get ready. Metals are really doing their thing, and you need to pay attention to metals going forward. Custom Smart Cash Index, which is the global market index. This is that trend line I was telling you that we need to get above. We are now dancing right above this level and could see a very strong reflation trade, 25-30% into early February, March, April 2023. This would be the global markets reflating, which the U.S. markets would do the same thing. If we fail, then we're coming back down here into these areas, 120, trying to retest these lows before trying to move higher. So it's really going to be dependent on what happens in early 2023. And of course, we're back over to the rotational modeling system allocation level. And then we have the custom stock market index. You can see the inverted head and shoulders again right here. Very solid. Left shoulder, central head, right shoulder. Neckline would be right across here, almost just below this blue line right here. We're flagging out right over here as well, this purple line and this blue line. We are going to be very surprised, I think, in my opinion, with a nice solid reflation trade in 2023. Otherwise, like I said, ladies and gentlemen, we're going to see this move down about an 8 to 10% lower and try to retest these COVID highs again back over here. It really kind of all depends on what expectations and earnings look like and whether or not the consumer rebounds in 2023 or not. I believe the consumer is actually a lot healthier than many people think. And I believe the U.S. consumer is. Now, there are at-risk consumers. There are lower end of the economy consumers. But again, I believe that consumers are generally moderately healthy. The top 60-70%, let's say, are moderately healthy and are just in shock as to what's going on right now. And then you have the bottom 15-20% that are very much at risk, that are really struggling right now. And that leaves the middle 20-25% that are kind of like, okay, we can make it as long as nothing really falls apart. Which is why I think that we've got to see how the Fed reacts to deflationary trends and how the consumers, again, that consumer index chart I showed you has consumers really pulling away. Let me see if I can find it real quick over here. Here it is. consumer index chart has consumers really pulling away. And this to me is a sign that GDP is going to go down. CPI is going to go down. You're going to see the unwinding of the inflationary excesses with consumers pulling away from the market. We do not want to see consumers pull away overly excessively. That means that we are going to see a recessionary type of trend really exasperate over the next 12, 24 months. But consumers acting the way they're acting right now, pulling away from big expenditures and kind of preparing to see what 2023 looks like, that's actually very healthy. That's the appropriate type of move that the Fed wants to see. And then they will start dipping their toes in once they start to see opportunities set up, which they have not seen yet. They are not seeing opportunity for price advance setup. They will, just like in 2023, in 2020, remember after COVID, in fact, let me find it over here. After COVID, remember over here, here's our COVID collapse, here's our rally, and then look, we didn't really start to see any real price appreciation until into 2021, when we had some real confidence that we could actually go higher and we weren't going to be moving into a deeper downward cycle. Same thing is going to apply over here. We could be looking at 10 months of consolidation and melt up just like this from here to here roughly before we start getting into some sort of a real appreciation phase. And that's where we're kind of like, this is the reflation trade right here. Here's our pullback. Here's our crisis like we had right here and right here. Here's the reflation trade. It could go all the way back to all-time highs and then an extra 10, 15, 20% higher before we start really seeing consumers go, okay, the water looks safe. Jaws has gone away. Risk of being chomped to death by some beast under where we can't see is gone. That's where we start to see this real reflation trade. All right, next. Oh, let me go back out of here and back to here and back to here. Custom valuations trend index, flagging out, stalling, end of year. This is actually good. We could see a little blip in the early portion of the year downward, so be aware. We could see that happen as earnings start to come in and lower expectations come in. But this to me is very healthy. And lastly, we have the custom volatility index, which is about ready to break to the upside potentially. We've seen, and I will show this to you again. We've seen an A, B, C, D, E potential pattern. A right across here up to this peak. B down to this low right here. C up to this high. D down to this deeper low. E up to this high and attempting to contract and then reflate back up out of here. And that's where I really think we're headed. I think we've ended this deflationary cycle trend. You can see we rolled over down into this cycle. We need to see this kind of move back up into this reflation cycle. And that's where I think we're headed, ladies and gentlemen. That's why I'm telling you, 2023 is going to be just super. 24 and 25 is potentially going to be super powerful. Metals could go higher. Oil could slide, potentially down into the 65, 67 area. U.S. stock market and U.S. dollar could stay stronger. U.S. dollar could stay above 103 to 107 in that area. While the global market searches for real solid footing. And like I said, the 2027, 28, 29, 30 areas where we reach real contagion, real crisis event, unwinding event type of a real concern. And if we're prepared for that and we trade efficiently over the next 4 or 5 months, that's where you could see gold and silver skyrocket. That's where you could really make a small fortune for your family by staying safely protected, taking advantage of the big global market trends, and preparing, knowing ahead of time, which remember, I've been telling you this for over 2 years now. What have I been saying? I have been telling you that 2027, 28, 29 is a massive crisis event. Up until then, we're ending wave 4, beginning wave 5, which should be a reflation trade to the upside. I keep telling you this every week, and I'm delivering you the tools that you need to go ahead and navigate this very efficiently. Now, can I accurately predict what happens 5, 6, 7 years out in the future? Nope. I don't know for sure that that's exactly going to happen exactly as I told you. But based on my research and based on what I'm seeing, I can tell you very efficiently that I believe this is the highest likelihood outcome based on what I'm seeing take place. Okay, guys, I think that's the last of my charts here. Yep. I'm going to try to do one more video and have a great new year. Remember, share it with your friends, please. I'm doing all of this research to try to help you and to try to show you how you can really grow your wealth. I mean, the next 7 to 10 years, we could see the biggest trends we've ever seen. We could see, you could triple your net wealth if you know what you're doing and you follow my research. Okay? I'm not saying I'm going to have all the answers, but I'm telling you, I'm going to do my best to help you navigate this efficiently, or more efficiently than all the other people that are just guessing at what's going to happen over the next 5, 6, 7 years. I mean, in a way, I'm guessing too. I will admit, I am guessing too, but I'm guessing based on 35 plus years experience and all of this technology I have built over the past 26 years to try to help me better gauge and understand what's actually taking place in the market. Not only that, but we have this little gem right there. Can hardly see it because it's kind of off the page, but right here is the MENT rotational modeling system algo running on weekly and daily on the SPY. And this is the core instrument that I use to keep you safely protected from crisis events. We have been bullish through this entire cycle up here. You can see we have been bullish. That's what these yellow lines are through this entire cycle event. And if this moves back into bullish trending, which we were very close back over here, if this moves back into bullish trending, then we're looking at a reflation trade setup. Okay, guys, please help me out. Share it with your friends. Tell people about what I do, and I'm going to try to continue to improve the service for you going into 2023. All right, Happy New Year, guys.